So, how does a nation's central bank spend 102% more in a single year without buying a single private jet or handing out massive bonuses or, building a shiny new corporate skyscraper?
Right. Yeah, it sounds completely impossible when you first look at the numbers.
Totally. Today, we are looking inside a 92 lakh crore shock absorber. I mean, when you read a standard corporate balance sheet, there's this expectation of, well, straightforward arithmetic.
Exactly. Revenue comes in, expenses go out.
Right. And the bottom line just tells you if the company survived the year, it's binary, profit or loss.
But central banking, it shatters that framework entirely.
Yeah.
Reading the Reserve Bank of India's balance sheet requires basically unlearning corporate accounting.
Yeah, which is tough.
It is, because a central bank doesn't exist to maximize shareholder value or, generate a quarterly profit. It exists to engineer macroeconomic stability.
And when you look at the raw data from the 2025-26 fiscal year, you are not looking at a normal business ledger.
No, not at all. You're looking at a financial mirror. It reflects global geopolitical turbulence, domestic liquidity demands, and, honestly, the systemic risk profile of an entire subcontinent.
Which brings us to the mission for today. If you're listening to this deep dive, you are likely staring down the barrel of a high-stakes policy exam, or maybe a senior promotion interview.
Or a strategic briefing where you just need to understand its architecture absolutely cold.
Exactly. So we are functioning as your senior analysts today. We are taking the foundation of the RBI Act of 1934, specifically pulling conceptual clarity from the 00 RBI F&W document, and we're crashing it right into the raw data from Chapter 12 of the 2025-26 annual report.
It's a great stack of sources to work with. The objective here is to build the engine of the Indian economy right in front of you, piece by piece.
So that you understand the underlying mechanics, not just memorize isolated data points, right?
Exactly. Mastering these accounts isn't about rote memorization. It's about seeing how risk management and statutory mandates actually shape the country's financial safety net.
Okay, let's unpack this. Let's start with the statutory blueprint. Because the 2025-26 numbers make zero sense without understanding the structural anomaly of the RBI's capitalization.
Yeah, we have to go back to the beginning. The Reserve Bank of India commenced operations on April 1st, 1935.
Right, as a private shareholders bank.
Exactly. And the initial paid-up capital was exactly 5 crore rupees.
Which is just wild to think about today.
It really is. But what trips up a lot of analysts is that even though the bank was nationalized in 1949, meaning its entire ownership was legally vested in the government of India, that paid-up capital remains exactly 5 crore today.
Wait, still?
Still, it sits right there on the liability side of the balance sheet under Schedule 1, unchanged for over 9 decades.
5 crore, I mean, in an era where we are going to be discussing financial movements in the lakhs of crores today, anchoring the entire institution to a 5 crore paid-up capital is mathematically mind-bending.
It perfectly proves your earlier point, though. Central banks do not operate on standard corporate logic.
Right, because a commercial bank has to constantly raise equity capital to expand its lending base, to meet Basel requirements.
Exactly. But a sovereign central bank, backed by the mandate of the state, well, it doesn't need to issue new shares just to operate.
Okay, so mark that down. That's a fundamental concept. Now, the reporting of all this activity is legally triggered by Section 53, subsection 2 of the RBI Act, right?
Yes, Section 53-2. It mandates the transmission of the annual accounts to the central government.
So they have to hand over the books?
Right. The RBI must deliver a copy of its accounts, fully audited, alongside a comprehensive report by the Central Board on the working of the bank throughout the year. And this has to happen within 2 months from the date the annual accounts are closed.
And recently, the RBI's accounting year was synchronized with the Government of India's standard April to March fiscal year. So the books for this reporting cycle closed on March 31st, 2026.
Which is a massive operational upgrade for policy alignment. It allows the central bank's surplus transfers to map perfectly onto the government's budget math.
That makes total sense. But let's look at the actual architecture of the balance sheet submitted under Section 53.2. Because there's a structural quirk here that is pretty fundamental to the whole system.
Oh, the two-pocket system.
Yes. The RBI does not operate a single unified balance sheet.
No, it operates a legally mandated two-pocket system. Section 23 of the RBI Act requires the issue of banknotes to be conducted by a dedicated issue department.
And that has to be kept completely distinct from the banking department, right?
Wholly distinct. The law says the assets of the issue department cannot be subject to any liability other than the liabilities of the issue department itself.
So the firewall is absolute.
Absolute.
Mm-hmm.
And to understand why that firewall is necessary,
Mm-hmm.
you have to think about the nature of fiat currency.
Okay, walk me through that.
Well, a physical banknote is, at its core, a promissory note. It literally bears the signature of the RBI governor stating, "I promise to pay the bearer the sum of whatever the denomination is."
Right, I'm looking at a note right now, and it says exactly that.
That promise requires immense institutional trust. The issue department exists exclusively to back that specific liability.
So by keeping its ledger entirely separate, the law guarantees that every single physical note in circulation is backed by distinct, tangible assets.
Exactly. Primarily gold bullion, foreign securities, and rupee coins, all held on the asset side of the issue department's ledger.
Wait, I have to play devil's advocate here. In the era of digital payments, UPI, complex monetary policy, why maintain this archaic two-pocket system of issue versus banking?
It does sound a bit old school.
It sounds like an operational bottleneck. Why run two distinct accounting realities when the money supply is increasingly a digital construct?
It really comes down to the foundational psychology of money. Even in a highly digitized economy, physical currency serves as the ultimate bearer asset.
Meaning whoever holds it, owns it.
Right. And if there is a systemic shock like a massive cyber failure or a crisis of confidence in commercial banking, physical cash is the final refuge of economic trust.
Right.
So that statutory separation ensures that this final refuge is never compromised by the daily complex operations of the central bank. The banking department handles everything else.
So the banking department is the one holding cash reserves for commercial banks, managing government deposits, and doing open market operations.
Exactly. It buys and sells domestic government bonds and holds the foreign exchange reserves that aren't actively being used for currency backing.
Okay, I want to give you an analogy to see if this tracks. Let's say you have two separate bank accounts for yourself.
Okay.
You have an untouchable vault account that purely back the IOUs you hand out to people. That's the issue department. And then you have a checking account for everyday business. That's the banking department. You cannot use the assets in the vault to pay for your everyday trading or to bail out a buddy.
That is a perfect analogy. The two just do not mix. The legal mandate is rigid for a reason.
Okay, that's definitely a key exam takeaway right there. Understand that two-department structure.
And here is a crucial policy caveat to add to your exam notes regarding issuance power. Section 22 of the RBI Act confers on the bank the sole right to issue banknotes in India.
Except for one specific note, right?
Exactly. The 1 rupee note is the statutory exception. Under the Coinage Act of 2011, the government of India retains the sole right to mint coins and issue the 1 rupee note.
So the RBI merely acts as the government's agent to distribute them.
Yes. The liability for that specific denomination sits with the sovereign government, not the central bank.
Wow. Okay. That is prime multiple choice material. Write that down. And underpinning this entire dual department structure is the preamble to the RBI Act, which explicitly states the RBI operates with a nonprofit motive, guided by the goal of securing monetary stability.
That nonprofit motive is the lens through which we have to view all these numbers.
Right. So now that we have the architectural layout clear, the vault of the issue department and the checking account of the banking department, we have to look at the unbelievable scale of the financial house they built on top of this in 2025-26.
The expansion data is truly breathtaking.
It is staggering. For the year ended March 31st, 2026, the RBI's balance sheet size increased by 20.6% year on year. It swelled to 91.97 lakh crore rupees.
Just let that number sink in. 91.97 lakh crore.
It's hard to even conceptualize.
Well, evaluating that absolute number requires some macroeconomic context. A 92 lakh crore balance sheet now represents 26.4% of India's entire gross domestic product.
Wait, really? Over a quarter of the GDP?
Yes, up from 23.7% the previous year. More than a quarter of the entire economic output of the nation is mirrored in the size of the central bank's ledger.
That is definitely a key exam takeaway. Flag that 20.6% expansion and the 26.4% GDP ratio. But so what does this all mean? How does it expand that fast?
Well, a balance sheet must balance, right? So a 20.6% swell means monumental movement on both sides of the ledger.
Let's start with the assets.
On the asset side, the growth was primarily driven by a 44.9% surge in domestic investments. And it was further accelerated by a 63.8% increase in the value of gold holdings, plus a 7.9% rise in foreign investments.
Okay, so when you see domestic investments jumping by nearly 45%, that's the banking department aggressively executing open market operations, right? Purchasing government securities to inject liquidity into the banking system.
Exactly. And the liability side expanded in perfect tandem to match them.
What drove the liability side?
We saw a 63.4% jump in revaluation accounts, an 11.8% increase in physical notes issued, and an 11.6% rise in deposits held by the RBI.
And those deposits include the cash reserve ratio balances that commercial banks are legally required to park with the RBI.
Right.
You know, the natural instinct when you see a corporate entity expand its balance sheet by a fifth in a single year is to assume, like, reckless leverage. You picture a company taking on massive debt for a crazy acquisition spree.
Yeah, it screams red flag in corporate finance.
But central bank mechanics dictate a totally different reality. Think of the balance sheet as the country's financial shock absorber.
I like that.
When the road gets bumpy globally, whether that's a spike in crude oil prices or the U.S. Fed hiking interest rates or capital flight from emerging markets, the domestic economy takes a hit. So the shock absorber has to expand to take the impact.
That's spot on. The central bank buys domestic bonds to keep local credit flowing and accumulates foreign currency to defend the rupee. The balance sheet essentially inhales and exhales in inverse proportion to global economic stability.
It expands its footprint to absorb systemic stress so the private sector doesn't have to.
Precisely. But a bigger balance sheet means bigger risks. Holding nearly 92 lakh crore in assets means the institution is heavily exposed to market volatility.
Because even a tiny fractional percentage drop in the valuation of those bonds translates to hundreds of thousands of crores in paper losses.
Right, so the institution must build internal firewalls to prevent those market fluctuations from eroding its fundamental capital base.
Which brings us to risk provisioning. And this leads into the most counterintuitive data point in the entire annual report.
Oh, I know the one you mean.
It's the number that makes you think there is a typo in the financial statements. In 2025-26, the RBI's total income increased by 26.4%, which is great, but its total expenditure skyrocketed by 102.4%.
A literal doubling of expenses.
The expenditure line went from roughly 69,700 crore to over 1.41 lakh crore. How does a central bank's expenditure double in 1 year? Did they suddenly hand out massive bonuses or buy a fleet of private jets?
No private jets. The employee costs only crept up by 10.8%, largely just standard pension revisions.
And the actual cost of printing physical currency declined, right?
It did. The massive expenditure spike is entirely driven by the Economic Capital Framework, or ECF. It's risk provisioning.
Okay, unpack the ECF for us.
The ECF is the foundational risk management protocol adopted by the Central Board. It's heavily informed by the recommendations of the Bimal-Jalan Committee. The framework requires the RBI to maintain a highly specific safety net called a contingent risk buffer, or CRB, and the mandate dictates that this buffer must be maintained within a strict band of 4.5% to 7.5% of the total size of the balance sheet.
Okay, let me walk through the mechanical logic of that just to make sure I have it right. Because the overall balance sheet exploded by 20.6%, the absolute size of this contingent risk buffer had to scale up proportionally.
Exactly. For 2025-26, the board evaluated the macro risk environment and locked the CRB target at exactly 6.5%.
And maintaining a 6.5% buffer on a 92 lakh crore balance sheet requires an astronomical amount of hard capital.
It does. To hit that exact 6.5% mandate, the RBI was forced to execute a massive cash injection. They transferred 1.09 lakh crore rupees realized, hard-earned income, directly into the contingency fund, or CF.
Okay, and under central bank accounting standards, this transfer to the CF is booked on the income statement under provisions, which is a subcategory of total expenditure.
You've got it. That single massive provision of 1.09 lakh crore is the sole reason the overall expenditure line mathematically doubled. It is not an operational loss. It's just aggressive mandated saving.
Okay, here's another analogy for the listeners. This is like a homeowner who's required by their HOA to keep 6.5% of their home's value in a dedicated repair fund.
That works perfectly.
So if your house suddenly doubles in value, you have to immediately dump a massive chunk of your salary into that repair fund just to maintain the percentage. On paper, it looks like a huge expense for the year, but you didn't actually spend the money. You just engaged in prudent saving.
That's exactly it. If we connect this to the bigger picture, the contingency fund is designed to absorb realized systemic shocks. If monetary policy operations result in severe losses, or if there's a catastrophic drop in security values, the CF absorbs the blow.
It protects that core 5 crore capital.
Exactly. It is the hard cash firewall.
Okay, so key exam takeaway here. Memorize the ECF contingent risk buffer target. It was locked at exactly 6.5%, and the contingency fund transfer was 1.09 lakh crore.
Those are absolute must-know figures.
But the contingency fund isn't the only safety net, because that CF, massive as it is, represents realized earnings set aside for risk. There's another, even larger pool of money on the liability side that didn't come from income at all.
Yes, the revaluation accounts. Specifically, the currency and gold revaluation account, the CGRA.
This is where the accounting gets really magical. In 2025-26, the CGRA swelled to a mind-bending 21.68 lakh crore rupees.
Compare that to the contingency fund we just discussed, which holds roughly 5.68 lakh crore in total. The CGRA is nearly 4 times larger.
So what's the core difference between the two?
The distinction is realized cash versus unrealized paper gains. The CGRA exists to capture the immense volatility of the global markets without corrupting the RBI's operational income statement.
Because the RBI holds massive amounts of foreign assets, like U.S. Treasury bonds, and massive physical reserves of gold.
Right. And accounting principles mandate that these assets must be marked to market. They have to be revalued constantly to reflect current exchange rates and global gold prices.
Okay, so let's look at the geopolitical environment of 2025-26. Global turbulence drove investors towards safe haven assets, so gold prices soared.
Yes. And simultaneously, macroeconomic pressures caused the Indian rupee to depreciate against the U.S. dollar. It required more rupees to purchase a single dollar.
Okay, wait, push back here. If the rupee depreciates, shouldn't that be a bad thing for India? Like, import bills for crude oil skyrocket. Imported inflation hits the consumer. Why does a depreciating rupee make the RBI's balance sheet look so good?
It's the ultimate accounting paradox. The RBI's balance sheet is reported in Indian rupees, but its most potent assets are denominated in U.S. dollars and physical gold.
Ah.
So if the RBI holds $1 billion US dollars and the exchange rate is 80 rupees to a dollar, that asset is recorded as 80 billion rupees.
Right.
But if the rupee depreciates under market pressure and the rate shifts to 85 rupees to a dollar, that exact same $1 billion US dollars must now be recorded as being worth 85 billion rupees.
Even though the central bank didn't actively purchase any additional dollars.
Exactly. Their operational reality hasn't changed at all, yet the rupee equivalent value of their portfolio just mathematically spiked by 5 billion.
And the exact same mechanism applies to the gold reserves.
Yes. If the global price of gold jumps by 20%, the rupee value of the physical bricks sitting in the vault jumps by 20%.
So because gold soared and the rupee depreciated, the rupee-denominated value of the RBI's foreign assets and gold holdings just exploded.
But here is the massive policy constraint. They cannot treat this 21.68 lakh crore increase as operational profit.
Right, they can't just transfer it to the government to build bridges or pay expenses.
If they attempted to monetize those unrealized paper gains, it would be catastrophic. It would require printing new domestic currency to match the paper increase, instantly triggering hyperinflation.
Wow.
Furthermore, these gains are ephemeral. If global tensions ease tomorrow, gold prices could plummet and the rupee could appreciate. That massive paper gain would vaporize instantly. If they had spent it, the balance sheet would be insolvent.
So to prevent that, accounting standards dictate that these unrealized gains must be quarantined.
Quarantine is the perfect word. They park it in the CGRA on the liability side of the balance sheet.
So the CGRA acts as a massive unrealized shock absorber. If the rupee appreciates heavily next year, driving down the rupee value of the dollar reserves, the CGRA will mathematically shrink to absorb that paper loss.
Leaving the RBI's actual realized operational income completely insulated.
Okay, key exam takeaway. The CGRA contains unrealized gains. It is the ultimate shock absorber for valuation changes. Know the difference between the contingency fund, which is realized cash, and the CGRA, which is unrealized paper gains.
And just a quick note, there's also the investment revaluation account, or IRA, which does the same quarantine function for the mark-to-market valuations of domestic and foreign securities.
Yeah.
But the CGRA is the absolute behemoth.
Got it. So with the paper gains out of the way, let's shift focus back to hard cash. The actual income, operations, and the legendary surplus transfer to the government.
Yeah, because despite the massive 102.4% jump in expenditure, which we now know was just provisioning, The RBI still ended the year incredibly profitable.
They concluded the 2025-26 fiscal year with a final distributable surplus of 2.86 lakh crore rupees. That's a 6.7% increase from the previous year.
Generating a 2.86 lakh crore surplus after provisioning for a 92 lakh crore balance sheet requires immense yield generation.
So where did this cash come from?
The central bank's income is primarily interest income, segmented into foreign and domestic sources. On the foreign side, income increased by 26.6% to over 3.27 lakh crore rupees.
Because the RBI doesn't just let billions of US dollars sit dormant in a digital ledger, right?
Exactly. They actively deploy the nation's foreign currency assets. They invest in highly liquid, top-tier foreign instruments, primarily U.S. Treasury bills and deposits with other advanced economy central banks.
And because the global interest rate environment remained elevated, they earned a great return.
Yes, the RBI achieved a 6.4% rate of return on foreign currency assets, up from 5.3% the prior year.
Okay, flag that 6.4% rate of return. And what about the domestic side?
Domestic income was equally robust. Net domestic income increased by 25.9% to roughly 1 lakh crore. The primary engine here is the interest earned on holding domestic rupee securities.
The government bonds they accumulated during open market operations.
Exactly. That specific interest income jumped heavily to 1.17 lakh crore rupees.
But wait, I recall that this domestic yield is partially offset by the costs of managing systemic liquidity, right?
Right. When there's excess cash flooding the commercial banking system, the RBI must absorb it to prevent inflation. They execute this primarily through the Standing Deposit Facility, or SDF.
So commercial banks park their excess cash with the RBI overnight, and the RBI pays them interest.
Yes, and that interest payout mathematically reduces the net domestic income. But even so, the overall yield on government securities remained dominant.
Now, I want to bring up a fascinating operational detail from the sources regarding physical operations. While employee costs saw a marginal uptick, the actual cost of printing physical money dropped.
Yes. It fell from 6,372 crore down to 4,875 crore rupees.
And the annual report attributes this decline to a lower indent for new notes. They basically just ordered fewer physical banknotes to be printed.
Which points to a deeper structural shift. The existing stock of currency circulating proved sufficient. This heavily implies that the systemic adoption of digital payment infrastructure is extending the lifespan of physical notes.
People are just using less cash, so the notes aren't wearing out as fast.
Exactly. It reduces the absolute demand for new paper issuance.
And speaking of physical notes, I want to highlight the MANI app, the Mobile Aided Note Identifier. This was in the report, too.
Oh, yes. The MANI app is a great RBI initiative.
It's designed for visually impaired citizens. You scan a physical banknote with your smartphone camera, and the app uses image recognition to provide audio feedback identifying the exact denomination.
It's a vital detail because it shows the RBI's push for inclusive currency management. It ensures confidence in the physical bearer asset across all demographics.
Really cool stuff. But pivoting back to the macro scale, this 2.86 lakh crore surplus transfer is a crucial lifeline for the central government, isn't it?
It is absolute lifeblood. Under Section 47 of the RBI Act, the central bank is legally required to transfer its surplus to the sovereign.
They can't keep the profit.
No. After making all necessary risk provisions and fulfilling statutory fund contributions, the remaining balance must be swept to the central government.
And in the government's budget math, this transfer is booked under non-tax revenue.
Right. In the 2025-26 fiscal year, the government successfully contained its gross fiscal deficit at 4.4% of GDP. Maintaining that fiscal discipline while still spending on infrastructure and welfare requires immense revenue.
So a record dividend of 2.86 lakh crore from the RBI bridges a massive gap.
Massive. Without that specific dividend, the government would be forced to increase its borrowing from the open market,
which would drive up bond yields, increase the cost of capital for the private sector, and crowd out domestic investment.
Precisely.
Okay, key exam takeaways for this section. The exact surplus transferred to the central government under Section 47 is 2.86 lakh crore. The decline in note printing costs is also a high-yield prelims pointer. And remember the government's fiscal deficit target of 4.4%.
All critical numbers.
So before we wrap up this study session, I want to look at the physical assets actually sitting in the RBI's vaults and digital ledgers. We've talked about all these astronomical accounting figures, but they have to be backed up by tangible reserves.
Let's dive into the vault data. The foundational asset remains physical gold. As of March 31st, 2026, the total gold holding is 880.52 metric tons.
880.52 tons.
Managing that volume requires complex logistics. They balance domestic storage and local vaults with international storage and highly secure facilities, like the Bank of England or the Bank for International Settlements, just to ensure rapid liquidity in global markets if needed.
Now, what's fascinating here is a tiny but crucial detail about those gold holdings. The physical mass of the gold only increased by 0.94 metric tons year over year.
Right, from 879.58 to 880.52.
They basically added a rounding error's worth of physical bricks to the vault. Yet, the value of gold held in the issue department shot up by 64.1%.
It spiked from roughly 2.36 lakh crore to 3.88 lakh crore.
Which perfectly illustrates the power of the valuation effects we discussed in the CGRA section. The mass remained almost static, but the rupee-denominated value exploded by 64% because global prices rose and the rupee depreciated.
It's the clearest possible demonstration of mark-to-market valuation effects driving balance sheet expansion.
It really is. Okay, alongside physical gold, India's foreign exchange reserves stand at $691.1 billion US dollars.
The scale of that reserve requires context. The annual report utilizes the metric of import cover. The $691.1 billion reserve provides an import cover of approximately 11 months.
Meaning if every single foreign capital inflow into India completely stopped tomorrow,
No foreign direct investment, no export revenue, no remittances.
the central bank could independently finance 11 months of essential imports.
Yes, covering the nation's requirements for crude oil, electronics, machinery, purely using existing reserves. And it provides an external debt cover of 90.3%, which effectively immunizes the domestic economy against sovereign default risks.
Huge. But okay, we've talked a lot about physical gold and paper notes and foreign treasury bills. What about the digital side? Is the RBI entirely stuck in the physical realm?
Definitely not. The 2025-26 balance sheet definitively establishes the RBI's footprint in the digital frontier.
Is the digital currency initiative still just a theoretical pilot, or has it materialized? Because if you look at Schedule 5 of the balance sheet under notes issued, there is a distinct liability recorded for CBDCR.
It is absolutely an active recorded monetary instrument. CBDCR is the central bank digital currency for retail use, the e-rupee retail, and the recorded balance stood at 771.6 crore rupees.
Which, okay, 771 crore is a tiny fraction of the 41 lakh crore in physical paper notes circulating.
It is minuscule by comparison, but its presence as a distinct liability on the issue department's balance sheet is a massive structural milestone.
It confirms the sovereign digital currency is officially integrated into the foundational accounting.
Exactly. And the central bank's digital footprint goes far beyond just issuing the e-rupee. The RBI is actively managing the macroeconomic risk of the entire digital public infrastructure.
Like the Unified Payments Interface, UPI?
Yes. The report highlights that UPI transaction volumes surged by 30% in 2025-26, surpassing an unbelievable 200 billion individual transactions.
200 billion.
Managing 200 billion high-velocity digital handshakes requires unprecedented systemic oversight. So to manage that risk, the RBI is accelerating the deployment of the Digital Payments Intelligence Platform, or DPIP.
DPIP.
Right. It aggregates network-level data to mitigate sophisticated digital fraud. The modern central bank has to simultaneously secure physical gold in subterranean vaults while engineering real-time threat detection for billions of microsecond digital transfers.
Wow. Okay, key exam takeaways. Memorize the gold figure 880.52 metric tons. Memorize the Forex reserves, $691.1 billion US dollars, or 11 months of import cover, and recognize CBDCR as an active liability on the balance sheet.
Absolutely.
Well, our briefing is coming to an end, so it's time to consolidate the knowledge. Let me run through a rapid-fire recap of the ultimate exam cheat sheet.
Let's hear it.
We have the statutory two-department structure separating issue and banking. We have the massive 20.6% balance sheet expansion. We have the strict 6.5% contingent risk buffer target resulting in a 1.09 lakh crore provision.
Yep.
We have the massive currency and gold revaluation account holding the unrealized paper gains. And finally, the record surplus transfer of 2.86 lakh crore.
That covers the core framework perfectly.
And to you listening, remember, understanding these numbers isn't just about passing the exam, it's about understanding the very heartbeat of the Indian economy. When you read a headline about government spending or inflation or the rupee's value, this 92 lakh crore balance sheet is the engine room behind it.
It really is the ultimate systemic anchor. But, analyzing the trajectory of this expansion forces a critical philosophical question about the future architecture of the economy.
What do you mean?
Well, the balance sheet is now scaled to represent 26.4% of the entire gross domestic product. If a central bank's balance sheet mirrors more than a quarter of the entire national economy, at what point does the defensive safety net actually become the primary engine of the national economy itself?
Oh, wow.
And if global turbulence continues, forcing aggressive balance sheet expansion and requiring ever larger risk provisions, how much larger can that shock absorber get before it changes the fundamental nature of central banking entirely?
That is a profound point. When the shock absorber is a quarter of the size of the vehicle it's attached to, the physics of the ride change completely. Something to mull over as you study. Good luck with your high-stakes exam, and we will catch you on the next deep dive.